Jerome Powell said that today's move by the Fed to cut rates by a quarter percentage point is a risk management. It was the central bank's first rate cut since December. All but one of the voting members were in favour of the decision, and the dissenter is the president's former economic advisor, Stephen Mirren. He voted for a larger 50 basis point cut, half a percentage point. It was his first meeting. He was only confirmed and sworn in on Monday after the Senate rushed it through. The chair, Jerome Powell, was asked what the rest of the committee thought of this 50 basis point cut.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year.
Well, that put the new man in his place. The Fed's dot plot shows a wide range of expectations for interest rates by the end of this year. If you look back at June, this is the picture that we had in June, where most predicted that, if you take a look over here, most predicted that you're talking around that sort of level. But now, fast forward, that implies just a couple of quarter point cuts. Now move forward to September, and you see this. You see a general lowering of expectations right across the board for a few more by next year. And then you see this and this, and they are the outliers. This is the rate cut. We don't know, but I'm a betting man, and I think that is the work of this man, Stephen Mirren. He is the new kid on the block. This was his first meeting. The rest of them, they all went for a quarter point, except for Mr. Mirren. So joining me now to put this into context is Loretta Mester, the former president of the Cleveland Fed, adjunct professor at finance at Wharton School, University of Pennsylvania. Would you have gone a quarter or a half? What do you think?
I would have supported the quarter. I think there's a case for that, and I would put it in the same way that Jerome Powell did, which is like there's downside risks to the labor market. The labor market's not falling off a cliff, but certainly job growth has slowed and the unemployment rate ticked up. So you can, take away some of the restrictiveness in policy by 25 basis points. You still want your policy to be restricted, though, because inflation is above the goal. It's been above the goal for more than 4 years. And there's reason to believe that inflation will move up as more firms pass through some of those higher cost of tariffs. So it's a good balancing between the two goals, which is what the Fed's always trying to do, is position policy to achieve over time both parts of the mandate.
What was interesting listening to Chair Powell was he was very honest when he says, look, this is a very unusual circumstance where both policy sides of the mandate are in quasi-conflict with each other, at least in contention, and you do which is the most important at the moment, and that would appear to be on the employment side. He was very forthright about this challenge.
It is a challenge because, you've had a shock that sort of is going to dampen growth. As prices go up, growth will probably get dampened some more. There's uncertainty about even the level of tariffs. So firms have been having to deal with that uncertainty. There's geopolitical uncertainty as well. So it's a very uncertain environment, but the effects of those policies, immigration policy, work on opposite sides of the mandate and push them in opposite directions. So that's a hard balancing act they have to pull off.
The more difficult issue in the wider sense now is whether or not party politics has now been introduced into the FOMC, into the Fed in a different way ever before. And it is about Mr. Mirren, whatever his qualifications may be. The reality is he gets railroaded through, and on his first meeting, he votes for a 50 basis point cut, which is almost, what the president has been calling for. Even Christopher Waller and Michelle Bowman, who wanted a cut, didn't go with that. So Does this call into question the independence of the Fed?
Well, I don't think today's vote and the dissent do. I mean, this is an economic environment where you should be expecting different policymakers to have different views about what appropriate policy is at the meeting and then going forward after this meeting. And so that, if everyone agreed and it was so tightly knit, I think that would be a bigger problem than if they show their different views. And that's what we saw today. I do think this whole environment that the Fed has been operating on with these, consistent attacks on the Federal Reserve are very damaging to the process of monetary policy making. I am very confident of the people I know on the FOMC, so everyone but Myron, that they went into the room and only cared about doing appropriate policy making. But the fact that there's even a question about that is it's a shame, because it really complicates the making of monetary policy. And we've seen that it could change over time. We should not take the independence of a central bank for granted. We should make sure that we preserve it, because it ends up being better for the public. You get better outcomes, you get more stable inflation, and you don't have the cost in terms of having to give up output. So again, it's worth preserving, and I don't think anyone should be complacent about it.
I'm grateful, as always, ma'am. Thank you so much, putting it into context and letting me.
Thanks.
Exactly. Thank you.